If you are the first in your family trying to build wealth, your biggest obstacle is not capital, it is cognition. Your brain is wired for short-term reward. Wealth is built on delayed evidence. And if you don't understand that conflict, you will sabotage compounding without realizing it. Today we break this using a simple model: the compounding patience gap, the gap between what your survival brain demands and what exponential mathematics requires. The compounding patience gap explains why intelligent, hardworking, first-generation builders interrupt their own wealth trajectory. Not because they are incapable, but because they misinterpret the early stage of exponential growth. It's 10:47 p.m. Daniel sits alone in a one-bedroom apartment, laptop open, investment app glowing. Spreadsheet half filled, salary entered, expenses deducted. There's not much left. He invests anyway. Not a dramatic amount, just consistent. He checks last month's returns, nothing impressive. He scrolls financial news, sees screenshots of fast gains, crypto spikes, day traders celebrating volatility. He pauses. His mind whispers, maybe you're moving too slowly. He refreshes the app again, still quiet. Daniel doesn't realize it yet, but this is the phase where most first-generation builders fracture. Not from loss, from impatience. Zoom out, early career, small office, before global recognition. Warren Buffett spent years compounding modest pools of capital in Omaha. No headlines, no dramatic surges, no viral wealth narrative. Just disciplined allocation, year after year. Or consider Aliko Dangote in his early trading years, before cement dominance. Before continental scale, margins were narrow. Capital rotated carefully. Growth was structural, not explosive. The visible curve was flat for a long time. But the internal discipline was consistent. Daniel's current phase is structurally similar, not in scale, in pattern. Flat visibility, high discipline, low external validation. This is the invisible architecture stage. Let's draw the curve. 2 lines. Line 1, linear growth. You invest 100,000, earn 10,000. You see 110,000. Your brain understands this. Effort, immediate output. Now exponential growth. Assume 20% annual compounding. Year 1, 100,000 becomes 120,000. Year 2, 144,000. Year 3, 173,000. Year 5, 248,000. Year 10, 619,000. Year 20, 3,833,000. Notice something critical. For the first 5 years, growth looks unimpressive. From year 10 onward, acceleration becomes visible. This is the mathematical reveal. The majority of visible wealth appears in the final third of the timeline. But your brain evaluates performance weekly. Compounding evaluates performance over decades. That is the compounding patience gap. The exponential curve is deceptive at the beginning. Flat does not mean ineffective. Flat means early. Now think differently. Instead of investing 100,000 once, you invest 100,000 every single month for 20 years. That is, 100,000 times 12 months equals 1,200,000 per year. 1,200,000 20 years equals 24 million total capital invested. You contributed 24 million over 2 decades. Now let's apply the same assumption, 20% annual return, which equals approximately 1.667% per month. 20% divided by 12. We now calculate this as a monthly compounding series. This is called the future value of a monthly investment annuity. Future value of 20% annually for 20 years equals 3,090. Now multiply 100,000 times 3,090 equals 309 million. After 20 years of investing 100,000 monthly at 20% annually, total invested 24 million. Final compounded value approximately equals 309 million. Interest earned alone 309 million. 24 million equals 285 million. Listen to that again slowly. You contributed 24 million. Time and compounding produced 285 million. What this proves. Now compare this to the earlier single 100,000 example. The single investment grew to 3,833.38 times. But the monthly discipline creates a multiplier effect because 1. New capital is constantly added. 2. Each deposit gets its own compounding timeline. 3. Time stacks on time. This is probability stacking plus capital stacking. The first 5 years will still look modest, but by year 15 to 20, acceleration becomes dramatic, not because of magic. Because of uninterrupted exposure, compounding does not reward the impatient investor. It transfers wealth from the distracted to the consistent. Now layer psychology. Your brain evolved to solve immediate threats: food, shelter, security, social validation. In many African households, financial pressure is not abstract. It is daily: rent cycles, family support, medical emergencies, extended obligations. Short-term survival is real. Globally, the pattern is similar. Young professionals in London, Lagos, Nairobi, Toronto all face rising costs and social comparison. Your nervous system says, speed up, optimize, react. But long-term capital says, extend horizon, stay aligned, ignore noise. Survival thinking values activity. Strategic thinking values consistency. Trading feels productive, compounding feels quiet. And quiet can feel like stagnation. This is where Daniel hesitates. Not because he lacks intelligence, but because delayed evidence feels unsafe. Here is the belief flip. Patience is not passive. It is structured non-interference. Most people don't fail because their strategy is wrong. They fail because they interrupt the curve before it steepens. Memorize this line. The market does not reward intensity of emotion, it rewards duration of alignment. Duration, alignment, time under discipline. When Daniel resists switching strategies for quick gains, he is not being slow. He is preserving exponential structure. Compounding is fragile. Each interruption resets acceleration. Thinking like a trader optimizes for movement. Thinking like a builder optimizes for time exposure. Different games, different psychology, different identity. If you are watching this channel, you are not here for adrenaline. You are here for architecture. First-generation wealth is not built through weekly excitement. It is built through decade-long coherence. This platform is for disciplined thinkers, for those willing to tolerate the flat years, for those who understand that early invisibility is not failure. It is formation. You cannot think like a trader. If you are building generational stability, you must think like a strategist of time. Protect the curve, close the compounding patience gap, and allow mathematics to work longer than your impulses. This is not urgency. This is structure. And structure is how the first millionaire in the family is built. This channel is not about motivation. It is about transformation. Every video you watch here is one step closer to becoming the first millionaire in your family. Not through luck, not through hype, but through discipline, structure, and long-term thinking. We are building thinkers. We are building investors. We are building legacy creators. And if you stay here long enough, apply what you learn, and study the blueprint inside the first millionaire in your family, you won't just change your income, you'll change your bloodline. So if this video shifted your thinking even a little, subscribe, because this is not just content. This is preparation. And 10 years from now, you'll either look back and say, I started when it was small, or I wish I did. Choose wisely. I'll see you in the next lesson.